1995 to 99 was a very eventful time in my life. It obviously was for the markets as well. If history doesn't repeat, but it rhymes, what exactly are the parallels between now and circa 1995?
Yeah, thanks. Good morning. The main parallels are that we have inflation that is lowering and an economy that is not collapsing. You've got the labor market that's slowing, consumers hanging in there. Inflation peaked 2 years ago and is now under 3%. So the Fed is in a good position here if they can be proactive enough. I'm not talking about intra-meeting moves, but I am talking about maybe a 50 basis point cut, half a point in September, and then maybe a couple more before the end of the year. With the economy still showing some resilience and inflation way past its peak, you've still got a good chance to soft land this economy. That means slowing growth enough that the Fed cuts, and then you begin to see credit prompt or promote more growth. So that's a good sign, a very strong connection between now and the summer of '95.
Okay, so then what are the key investor takeaways now, Paul, given the fact that we did see this massive, almost, I mean, it is historic run back during that time frame? Can we expect the same kind of thing now? It feels as though much of that has already been priced into the market.
Yeah, so no, as you say, history rhymes. It doesn't quite repeat. And over the next couple of months, yeah, we are expecting some periods of volatility, especially associated with this election. Geopolitical tensions also are very high right now. And we've seen some reduction in liquidity available to go into markets as a result of the carry trade getting extended and then having to pull back. So there is some chop that's likely to show up in markets, especially the S&P 500, over the next couple of months. But after that, what will happen, we think, is, again, the Fed being proactive, not just a couple of cuts, but several larger ones, or in combination. That bringing the short-term interest rate down by a full percentage point, that should start helping, for example, financials, right, which pay interest rates on deposits. And then you see the long-term rates also come down. The short rate comes down by more, so they're gaining more on what they save in deposits, the deposit interest, than what they lose in lost bank revenue, loan revenue, and so financials should benefit here. We also expect tech to benefit once again. As those long-term interest rates come down and earnings get discounted by less, then the tech sector should rebound here nicely. And that's exactly what happened in 1995. Financials led the way until tech took over. And then you had a general cyclical move out of stocks going forward. We've positioned by going favorable financials and by going favorable comm services, which is a tech lookalike. And then we've also positioned by going back to neutral on small caps, where we had been very underweight. We didn't go overweight here because, unlike in 1995, we don't think it's smooth sailing from here on. There's still some of those events coming up that we think are worth preparing for. So a neutral position is good for small caps right now, but we would be definitely overweight large caps and in the sectors that I mentioned.